Welcome to CatEye U.S. stock. We watch markets with calm focus and sharp instincts. It's Wednesday, February 4th, 2026, and the market closed with a sharp split. The S&P 500 slipped, the Nasdaq slid even more, but the Dow, it finished at new highs. This wasn't a crash, it was a re-rating. AI and software leaders finally hit a wall while old-school value, healthcare and energy quietly took the baton. Tonight's story is that tug of war, AI leadership fatigue on one side, a defensive value-heavy rotation on the other, and in between, a market that looks weak at the index level but a lot more resilient under the hood. Pull up the S&P 500 heatmap and the story just jumps out. Most of the board? Green. Financials, energy, staples, industrials, even a lot of real estate and materials, all showing steady bids. Then, your eye hits the red. Deep, concentrated red, semiconductors, high beta software, internet platforms, EVs. Even inside the megacap block, you see the split. Apple and Microsoft holding up in healthy green, while Nvidia, Alphabet, Meta, Amazon, Tesla sit in that heavy red zone, the visual takeaway. Participation was broad, but the pain was brutally concentrated in the former AI generals. That heat map feeds straight into the money flows. 7 of 11 S&P sectors finished higher. Capital left the high beta growth corners. AI semis, richly valued software internet platforms, EVs, AMD's collapse turned semis from leadership into liquidity. Names like Palantir, Snowflake, Datadog all traded lower together. So where did that money go? Into perceived quality and cash flow. Big pharma and biotech, led by Eli Lilly and Amgen. Financials from big banks to asset managers, energy majors, and resource names and materials. Plus a steady bid in staples and parts of real estate and industrials. This wasn't an everything sells day. It was a rotation day, away from story-heavy AI exposure toward earnings visibility and balance sheet strength. Underneath all of this, there's a very specific tension. By the close, the big story wasn't macro fear. The 10-year sat near 4.29. No fresh rate shock. No new recession headline. Instead, the stress sat squarely in AI and software. AMD's guidance cut into forward confidence, Nvidia, and a string of expensive software names repriced with it, yet the average stock finally caught a bid. The Dow made new highs. 7 sectors green, breadth positive. So you've got this high-stakes tug of war. AI leadership fatigue on one side, a defensive value and healthcare rotation on the other, and a market that looks fragile at the index level, but far from a full risk-off regime, at least for now. In the background, the rumor mill wasn't about the Fed, it was about the data itself. A brief government shutdown pushed the official January jobs report back to February 11th. That delay plus a weak private payrolls print left the macro signal muddy. On desks, the chatter wasn't about a new macro shock, it was about flying blind for a bit. How clean will the delayed data be? What does that do to confidence in the next read on labor? None of this is confirmed as a game changer. But it did do one thing today. It pushed traders deeper into single-name earnings and positioning. If you can't trust the macro read in real time, you trade the micro even harder. AMD beat earnings, and the stock still sold off. That's not a contradiction, that's the market telling you what it actually cares about. Investors weren't trading last quarter's results, they were trading forward confidence. The problem wasn't revenue, it was guidance, and what it implied about AI demand momentum. In this tape, semiconductors stopped being leadership and started becoming liquidity. When traders need to reduce risk, they don't sell what they hate, they sell what they can. That's why AMD didn't bounce, and that's why tech couldn't lift the market today. Software stocks didn't fall because earnings missed. They fell because AI just changed what a workflow is. Tasks that once needed multiple tools, licenses, and teams can now be done in a single prompt. That's why names like Palantir and Snowflake sold off together. This wasn't company-specific, it was business model-specific. The market isn't panicking, it's repricing. In 2026, the key question isn't who has the data, it's who still owns the workflow. If you think AI money left the market, it didn't. It rotated. While software sold off, hardware names caught a bid. Companies tied to real servers, real orders, and real delivery like Supermicrocomputer held up or moved higher. This market's no longer paying for ideas, it's paying for execution. Cash flow beats concepts, visibility beats vision. The AI trade isn't dead, it's getting selective. While AI and software stocks struggled today, one name jumped, and it wasn't because of AI. This move was driven by buyout speculation, not technology optimism. In a fragile market, investors are paying up for certainty, real deals, real transactions, real outcomes. That's why this stock worked while high beta tech didn't. Today's tape sent a clear message: when confidence is thin, capital chooses closure over disruption. In this market, a signed deal can matter more than the best AI story. One stock grabbed everyone's attention today, not because of fundamentals, but because of options. Call volume exploded far above normal levels. But here's the key point: options activity shows interest, not conviction. Most of this flow was short-dated traders chasing momentum, not building positions. Gamma can move prices in the short term, but it doesn't create a trend by itself. In a fragile market, it's critical to separate noise from signal. And today's options frenzy, that was noise. Let's start the stock rundown with AMD, the name that rewired the whole tape. AMD beat on last quarter, but its softer revenue guidance and AI ramp timing undercut the dream. The stock dropped more than 17%. That one move did two things. It became the pin for crowded AI positioning, and it turned semiconductors from leadership into a shock absorber. As AMD cracked, Nvidia, Micron, Broadcom, and global chip names traded lower in sympathy. For index investors, that meant a lot of red in a very concentrated corner of the S&P and Nasdaq. This was the market saying, show me the future cash, not just the AI story. Next up, Nvidia, the bellwether everyone means when they say the AI trade. Today, Nvidia didn't blow up on its own news, it just got pulled into the AMD vortex. The stock lost a little more than 3%. That matters because there was no new fundamental bomb. This was pure positioning and sentiment. If AMD's guidance can drag Nvidia lower, it tells you how tightly the markets linked the entire AI hardware complex. Traders will keep using Nvidia as the read. If this one can't stabilize the broader AI basket, derating probably isn't done. Palantir is the clean example of how the mood flipped. The company put up strong quarter-on-quarter growth, fresh upgrades, solid AI narrative, and the stock still fell more than 10%. Why? Not because the business suddenly broke, but because the multiple was already rich, and the whole AI software bucket was getting repriced at once. Palantir's tape really sums up the day. Good isn't good enough when expectations are stretched. AI workflows may be real, but investors are no longer giving software a free pass on valuation. On the other side of the ledger, Lilly, the stock that kept the tape from feeling outright broken. Lilly delivered a blowout obesity and diabetes quarter. Mounjaro, Zepbound, and a strong pipeline drove an assertive outlook. The stock jumped more than 10%. That move did more than pad Lilly holders' P&L. It turned Big Pharma into a new defensive growth refuge. Amgen and other large-cap healthcare names rode the wave. In a session where AI software was getting marked down, Lilly showed there's still big money willing to pay up for tangible demand and durable cash flows. Super microcomputers sat right at the crossroads of the AI debate. While AI software and semis were getting hit, SMCI ripped higher on raised guidance and explosive AI server demand. We're talking a double-digit percentage move up. This is that AI shovels, not just AI stories idea in real time. Real orders, real boxes shipping, real revenue prints. The message from the tape is simple. AI money isn't gone. It's rotating inside the theme, away from long-duration software promises toward hardware names where investors can actually see the demand in the numbers. Finally, a quick look at Exxon Mobil, old energy, new relevance. While AI and software were repricing, Exxon quietly pushed toward its highs. Supported by steady energy prices, progress on costs, and solid production. In a session defined by AI fatigue, EXOM represented the other side of the trade. Cash-rich, dividend-paying, tied to the real economy. It's not about excitement, it's about ballast. And days like this remind you why. Institutional money keeps one foot firmly in these value-heavy cash flow engines. So where does this leave you heading into the next session? Near term, there's no major macro print to reset the story. The January jobs reports pushed to February 11th. Today's weak private payrolls reading just adds to the fuzziness. That means the market's trading the gap between micro and macro, single-name earnings, guidance tone, positioning. Watch the AI bellwethers, AMD, Nvidia, Palantir for signs the derating is stabilizing or spreading, and keep an eye on the new defensive leaders Lilly, Big Pharma, energy majors. As long as breadth stays decent and value keeps catching flows, this still looks like a rotation, not yet a full-blown risk-off break. To wrap it up, today wasn't about markets falling apart, it was about who leads and who finally takes a breather. AI and software lost altitude. The Dow hit new highs. Value, healthcare, and energy stepped forward. Index charts look ugly because leadership was so narrow, but under the surface, the average stock finally caught a bid. From here, the story really splits in two. If earnings and upcoming data cooperate, this looks like a healthy, if painful, rotation. If they don't, those cracks in AI leadership could widen fast. We'll leave it there for tonight. Next session we'll find out whether this was a one-day reset or the start of a longer handoff away from the AI darling. Thank you for watching CatEye U.S. Stock. Stay curious, stay calm, and we'll see you next time.